Is the world's most prominent artificial intelligence company a revolutionary force or a house of cards teetering on the brink of collapse? Could the very entity that ignited the global AI frenzy be hurtling towards a fate reminiscent of history's most spectacular corporate implosions? As whispers of astronomical cash burn and insatiable capital demands echo through financial markets, one must ask, is OpenAI destined to become the WeWork of the AI era, a cautionary tale of hype overwhelming substance? Or is its monumental spending a necessary investment in building the foundation of a new technological epoch? What happens when a company's valuation is built not on profit, but on the promise of a future that is still being written, a future that consumes capital at an unprecedented rate? The parallel drawn between OpenAI and the ill-fated office-sharing giant WeWork is not merely a sensational headline. It is a stark reflection of a deep-seated anxiety within the global investment community. The concern originates from a simple, yet terrifying financial reality: OpenAI's staggering cash burn rate. Despite generating revenues that would be the envy of most corporations, the company is hemorrhaging money on a scale that defies conventional business models. This dynamic evokes the ghost of WeWork, a company that captivated investors with a narrative of disruption and boundless growth, only to crumble under the weight of its own unsustainable spending and inflated expectations. The fear is that OpenAI, much like its predecessor in hype, is caught in a cycle of raising colossal sums of capital simply to finance its operational deficits, creating a precarious dependency on market sentiment and the continued generosity of its backers. Leaked financial projections paint a harrowing picture of this dependency. The figures suggest an impending cash burn of $17 billion in 2026, a dramatic escalation from a projected $9 billion in 2025. This bonfire of capital is expected to continue raging, with the company forecasted to remain unprofitable for at least the subsequent 3 years. This financial vortex exists despite the company having already achieved a historic, and perhaps dubious, milestone, raising over $60 billion, the largest sum ever amassed by a private enterprise. The primary culprit for this fiscal drain is the voracious and ever-increasing demand for computational power. The energy required to train and run its sophisticated models is soaring, projected to leap from 200 megawatts in 2023 to a staggering 1.9 gigawatts by 2025, an almost tenfold increase in just 2 years. This insatiable appetite for power and processing is the engine of OpenAI's innovation, but it is also the anchor dragging its balance sheet into the abyss. This precarious financial footing has not deterred the company from dreaming even bigger. Rumors are circulating of a new funding round that could seek as much as $100 billion, potentially catapulting its valuation to an astronomical $830 billion. This potential valuation, built not on current profitability, but on the promise of future dominance, intensifies the comparison to WeWork. Both entities achieved meteoric rises in valuation based on compelling narratives and the powerful backing of influential investors long before demonstrating a clear, sustainable path to making money. The critical difference, and what makes the OpenAI situation potentially more systemic, lies in the nature of its dependencies. While WeWork's collapse was largely contained, OpenAI sits at the epicenter of a new, deeply interconnected technological ecosystem. This ecosystem creates a level of systemic risk that far exceeds the WeWork saga. In 2008, the global financial system was brought to its knees by the intricate and opaque dependencies between major banks, all linked by complex financial instruments. A similar, albeit technologically focused, dependency is forming around OpenAI. The company has become the most crucial customer for a new generation of AI infrastructure providers, particularly the manufacturers of the specialized chips essential for AI development. Should OpenAI falter, the contagion could spread with terrifying speed. A crisis at OpenAI would send shockwaves through its network of partners. With a company like NVIDIA, the undisputed leader in AI chip manufacturing, facing a catastrophic loss of its premier client, the resulting panic could trigger a domino effect, undermining confidence in the entire AI hardware sector and potentially triggering a broader market correction. The risk is no longer just about a single company's failure, but the potential destabilization of the entire technological supply chain that has been built around the promise of an AI-driven future. OpenAI's risk is not one of bad debt in the traditional sense, but of a vast, capital-intensive network built on a foundation of shared belief and mutual dependence. While OpenAI's revenues are indeed growing at an explosive pace, with projections suggesting they could reach $20 billion annually by the end of 2025, a dangerous countercurrent is strengthening. Cost of inference, the computational expense incurred every time a user interacts with a model like ChatGPT, threatens to outpace this impressive revenue growth. This problem is particularly acute for the millions of users on the free tier of ChatGPT, each query adding to the company's operational deficit without a corresponding income stream. The competitive landscape only exacerbates this pressure. The rapid advancement of rival models, such as Google's Gemini family, which have demonstrated superior performance on various benchmarks compared to even unreleased versions of OpenAI's models, has led to signs of user stagnation. This looming threat forced CEO Sam Altman to initiate a code-red mobilization within the company, a temporary all-hands-on-deck effort to enhance ChatGPT's capabilities and fend off the encroaching competition, a clear signal that its market leadership is no longer guaranteed. Faced with this existential challenge of capital dependency and intensifying competition, OpenAI is embarking on a frantic, multi-pronged strategy to diversify its revenue streams and prove its long-term viability. The company is exploring avenues that move it beyond its core model of selling API access and premium subscriptions. A significant shift is the planned integration of advertising into the ChatGPT experience, slated for 2026. This move, while potentially lucrative, risks alienating users and diluting the product's perceived value. Simultaneously, OpenAI is considering transforming its chatbots into commercial gateways, allowing businesses to sell products and services directly through the platform in exchange for a transaction fee. This would position ChatGPT not just as an information tool, but as a direct participant in the e-commerce ecosystem. Beyond consumer-facing initiatives, a major strategic pivot is underway towards the enterprise market. The company is aggressively pursuing high-value B2B contracts, aiming to embed its technology deep within the core operations of major corporations. To support this effort, it is establishing a dedicated technology implementation consulting department, a move that mirrors the strategy of established enterprise software giants. This B2B focus represents a more stable and predictable revenue path, insulating the company from the volatility of the consumer market. Perhaps the most ambitious element of its diversification strategy is a push towards vertical integration. Following the playbook of tech titans like Google, OpenAI is reportedly developing its own custom-designed AI chips in collaboration with Broadcom. This would reduce its reliance on third-party suppliers like NVIDIA, offering greater control over its technology stack and potentially lowering its astronomical computing costs. The company is also rumored to be exploring the development of its own consumer hardware devices, a bold leap that would pit it directly against established players like Apple and Google, further signaling its ambition to become a fully integrated technology conglomerate. As these strategic initiatives unfold, will they be enough to steer the company towards sustainable profitability? Or are they simply frantic attempts to patch the leaks in a ship that is taking on water too quickly? Can OpenAI successfully transition from a celebrated research lab and showcase of technological marvels into a resilient, money-making machine capable of justifying its colossal valuation? The coming years will serve as the ultimate crucible, a decisive test of whether Sam Altman and his team can navigate the treacherous waters of market expectations, technological competition, and their own monumental burn rate. What does a sustainable future for foundational AI models truly look like? And can it be built without first erecting a mountain of capital so high that its collapse threatens to bury the entire landscape? How does an entity built on the promise of artificial general intelligence reconcile its lofty ambitions with the brutal, quarterly demands of financial sustainability?